Hello there. Today I'll be taking you through the equity investments bit from the CFA Level 1 syllabus. So what I'll try to do here is explain, in addition to explaining the LOS, of course, I'll try to relate to the actual industry practice or the best practices followed by the industry practitioners based on my experience wherever possible. So let's take a look at what we've got installed here. So I've broken down these by topics for each study session, so that it's kind of easier to distinguish between various topics. So we start with market organization and structure, and here's the ground to cover, more of an agenda. So we look at different market terminology to begin with. So considering someone's facing the markets or the securities world for the first time, how is the purchase and sale of the securities happens in the market and the returns associated to them, the type of market orders, of course, how do you book a trade, what are the prices to consider, etc., and a bit of regulation surrounding all of this, of course. So let's kick off first to see how the financial system works or functions to begin with. So for any market, in essence, it's essential that there is a financial system to back it up, and the environment is conducive for the participants to effectively utilize the market space. So we've here the three main functions of the financial system. The first one being the system such that it allows entities to do various kind of activities, including savings, borrowings, issuing capital, equity capital, manage risk, exchange assets, and utilize information. So these are all kind of ingredients for an effective market space. Second is, of course, determining the return that equates the aggregate saving and borrowing, which means that for any given market there will be a appetite to save and borrow, and in order for these to end up in an equilibrium point, there needs to be a return that determines what's kind of a equilibrium for these savings and borrowings. The third is, of course, allowing the efficient movement of capital or capital allocation. So wherein investors are free to choose the type of assets they want to invest in and thereby diversify their savings across various asset classes. So keeping that in mind, we move forward to see what are the different types of assets and markets. So here you can see I have listed down different types of assets which are basically been traded by the investors in the securities world, so to say. So you have financial assets, of course, which includes equities, bonds, shares, and stuff like that, which is generally traded on the stock market. Real assets are, of course, those which are a non-electronical form, really, which is more of a tangible asset in a way. It's like your computers or machinery or buildings or furniture or things like that. You have a debt security, of course, which is more for borrowing, borrowing the debt by companies in form of bonds, debentures, commercial papers, etc. And you have equity securities, which is more for ownership in the company. Again, you have a public security and private security. So a given equity can be a publicly listed company traded on a stock exchange, or it could be a private security. You'd have a physical contract for derivatives like those for some of the commodities like wheat or soya or crude oil, things like that. You can have physical contracts for those, as well as those traded on the exchange, mainly CBOE or Chicago Mercantile Exchange. Then you have a spot in the futures market, of course. So that's valid for equities, commodities, and various other instruments. The derivatives, of course, futures and options market. Primary market, secondary market. We'll see more of this as we come to that section. Money market, capital market. So money market's basically more short-term in nature, and capital market, as we understand, is more of a long-term affair. Traditional versus alternative investments, of course. So traditional being things like equity and bond, and alternative, of course, more exotic, so to say, like hedge funds or futures or currencies. interest rates, things like that. Moving on. So what are the different type of securities or the assets that we usually deal with in a market space? So when we speak about securities, the most common thing that comes to our mind is of course the equity and the fixed income. So primarily common stock, preferred stock, bonds, commercial papers, etc. We might see some of these instruments in more elaborate details in slides to come. But this take this as an overview for now, and then more like a foundation for things that we'll learn in the subsequent slides. Then you have the pooled investments, of course, the more like a bucketed kind of investments, which mutual funds or hedge funds. Contracts generally include the one for derivatives like the futures, forwards, options, swaps, etc. In the commodity space, we have the agricultural products or metals or energy, the crude oils of the world and things like that. And again, you have a spot as well as the futures or forward market for them. And finally, currencies, wherein we have the spot currency market or the forward or futures, the derivatives market, which is like the commodities and the securities bit. Next, we see the type of financial intermediaries or the participants which are involved in the market space. So to begin with, we have brokers, which are basically intermediaries that connect the buyers and the sellers. It's more like a middleman if you think about it, and so that effective trade gets executed at a desired price. We need brokers. We need brokers in the market. So they provide centralized location for trading. It's kind of a platform where buyers and sellers can stand on the same stage and exchange the underlying securities. We have dealers, which are again kind of a intermediary. At the same time, they trade on their own books. So dealer is more like a inventory maker, so to say. So dealer may buy something on his own capacity or sell stock out of his own inventory, unlike broker, which is purely a middleman kind of arrangement. Next, we have arbitrageurs. So these are basically people who would buy and sell in some similar market or maybe different set of markets, so as to profit from the inefficiencies or the mispricing, really. We'll see more of these in the slides to come, but as I said, just take this as a foundation for now, and then we see how things shape up in the coming slides. You have securities and depository institution. So these are basically large banks or financial institutions which kind of pool different assets and then securitize them or kind of make a piecemeal products out of this. Then we have insurance companies who create diversified pool of risk, and manage the inherent the risk of providing the insurance in those assets. And we have a clearinghouse, of course, for things which are traded on exchange. So clearinghouse is basically the one who guarantees the counterparty claims, so that there's no real default, so to say.